everything about liabilities. Liabilities are financial obligations or debts that an individual, business, or organization owes to others. They represent claims on an entity's resources, and these obligations can result from past transactions or events. Here's a comprehensive overview of liabilities. Types of liabilities. Current liabilities. These are short-term obligations that are expected to be settled within 1 year or one operating cycle, whichever is longer. Common examples include accounts payable, short-term loans, and accrued expenses. Non-current liabilities, also known as long-term liabilities, these are obligations that are not expected to be settled within the next year. Examples include long-term loans, mortgages, and deferred tax liabilities. Common examples of liabilities. Accounts payable, money that a business owes to suppliers for goods or services received. Short-term loans, borrowed funds that are due within 1 year. Long-term debt, loans and bonds with repayment terms beyond 1 year. Accrued liabilities, expenses that have been incurred but not yet paid, such as accrued interest or salaries. Mortgages, loans used to finance the purchase of real estate with a long-term repayment schedule. Wages payable, employee wages and salaries that have been earned but not yet paid. Taxes payable, unpaid taxes such as income taxes or property taxes. Deferred revenue, payments received in advance for goods or services that will be provided in the future. Key points about liabilities. Obligations. Liabilities represent legal or financial commitments to repay borrowed funds, fulfill contractual obligations, or settle financial claims from third parties. Balance sheet. Liabilities are a crucial component of a balance sheet, a financial statement that presents an entity's financial position at a specific point in time. They are reported on the right side of the balance sheet, with assets on the left. Classification. Liabilities are typically categorized as either current or non-current on the balance sheet, depending on their expected settlement time frame. Interest expense. Many liabilities, especially loans and bonds, carry interest expenses, which represent the cost of borrowing money. Impact on net worth. The difference between an entity's assets and liabilities is known as net worth or equity. A positive net worth means that assets exceed liabilities, while a negative net worth indicates that liabilities exceed assets. Risk management. Effective management of liabilities is essential for financial stability. Excessive or poorly managed liabilities can lead to financial distress or insolvency. Disclosure. Publicly traded companies are required to disclose information about their liabilities in financial reports to provide transparency to investors and creditors. Creditworthiness. The amount and types of liabilities can impact an individual's or company's creditworthiness. Lenders and creditors assess an entity's ability to repay its debts. Understanding and effectively managing liabilities is crucial for financial planning, risk management, and overall financial health. Properly managing and balancing liabilities with assets is essential for maintaining a stable and secure financial position.